Good morning, good afternoon, good evening, wherever you're located on the earth. It is time for the PulseWave report of yours truly, the Algo Capitalist, aka the Vulcan, coming to you live from PulseWaveTrading.com, home of the world famous PulseWave price trigger reports. Okay, so it's another day. Pretty quiet, pretty tame for the most part. Seeing a little significant pullback here in the Bitcoin, but other than that, not a lot of noise going on right now. So I guess you can call this what, the quiet before the storm, something like that. We've been focusing on patterns and trends. Yesterday we dealt with the automated trading, and before that we looked at what to do with sideways moving markets. But there's an age-old war that's been brewing, and that is the war of marriage. I'm not talking about marriage of a man and a woman and they start a family and have children. I'm talking about the marriage between price and time. Price and time do not go together. Price and time can never be on the same page. Price and time move in opposite directions. For centuries, man has been trying to marry price with time, regardless of being aware that they hate each other. They will never come together. They move in opposite directions. Time is its own thing, price is another, and they just don't go together. So man has been building a bridge between price and time. How can we bring these two things together? Price and time. Some would argue and say everything comes down to one's timing. If you can time something perfectly, then you can benefit. Others will argue and say that is poppycock, hogwash. It's all about the price. If you can get in at the right price, then it doesn't matter what time you do so. What matters more important is the price. I'm here to dispel the myth and to give you the truth, to give you the real between the relationship of price and time when we're talking about financial assets, whether it be cryptos, whether it be stocks, futures, forex, or even baseball cards. Price beats time, ladies and gentlemen. I know there are people that don't want to hear that, but price beats time. Always. 100%. Make no mistake about it. All right? We're talking about assets. We're talking about trading. We're talking about the markets. Price and time. I've done illustrations on this channel going back many years where I spoke on it and showed you even examples using various charts and going all the way back and bringing it to the present. But now we need to just have the talk. We need to explain price to everybody. Okay? Attempting to time something is a monumental task because unlike God, we are not eternal. We do not exist outside of time. Time was created for man. Therefore, man is a prisoner of time. Once you understand that basic concept, you will begin to understand the relationship between price and time in the market. Is there a right time and a wrong time to purchase a particular asset class? That is not the correct question. The correct question to ask is, what is the correct price to buy a particular asset? Everything that can be known, everything that is known, has already been factored in to the current price of any asset, whether it be baseball cards, bottle cap collections, precious coins. Doesn't matter what it is. It all comes down to price, not time. You cannot put a price figure on time. Time is all over the place. Time can be sped up, time can be slowed down, time can be stopped, but price is eternal. The price of something is the price of something at that moment in time, and it is prone to fluctuate thereafter. If prices stayed the same, then there will be no issue between the price and the time debate because they could be evenly matched, therefore easily married to one another. Because it wouldn't matter when you bought something if price never changed. Wouldn't matter. Also, it wouldn't matter what price you bought it at because the price never changes. So if prices never changed, then price will become irrelevant, and so would time. Again, we're relating this to investing, to trading. We're relating this to the markets. We're not talking about anything else. We're talking about the markets. If a loaf of bread was always 10 cents, if it was 10 cents 100 years ago, if a loaf of bread was 10 cents 1,000 years ago, if a loaf of bread is still 10 cents today when you go to your local supermarket, then you're not concerned about price. And therefore, you're also not concerned about time. It doesn't matter when you bought the bread in the last 1,000 years because it's always been 10 cents and the price has never changed. Your ancestors, when they bought that same loaf of bread 1,000 years ago, it was also 10 cents. Didn't matter. Okay? Now we're ignoring inflation and cost of living. We're ignoring all of that. We're just looking at raw price data, price. What this means for us in our trading of variable assets and asset classes. It's important to know because price is not static. Price is ever changing. Some prices change more rapidly than others. When that happens, we call that volatility because the price is going up and down constantly. Sometimes we have these variable wide swings in price. Today, the loaf of bread is 10 cents. Yesterday, the loaf of bread was $50. Tomorrow, the bread will be 7 cents. That is what we call volatility. When you have extreme volatility like that, it makes it very difficult to get your finger on price because price is ever changing and it's doing so rapidly and it's doing it grossly where yesterday was $100, today it's 10 cents, tomorrow it's 7 cents, and then the next day it's $65. That is wild. Okay, when we have prices going out of control like that, there has to be a mechanism in place by the investor to ascertain what is the correct value, what is the correct price for you to purchase that particular item, that particular asset. The time, people will say, well, you know, it matters not the price, but it matters the time that you bought it. And they will argue, well, see, if you bought the bread before it hit $100 yesterday, if you bought it at a price lower than that, then you could have sold it and made a substantial profit, right? But again, listen to the argument. The argument is, had you brought it at a lower price before the price reached $100, even the time advocates use the word price in their argument. Time individuals cannot argue apart from price in their argument. So time advocates have a dilemma. The dilemma is, had you brought it any time before yesterday when it hit $100, you could have made a profit. Again, they're saying time, but they're not being specific with what time. At what time in the past would have been the opportune time to purchase that asset? They can't tell you that without looking first at a historical price chart. They have to chart it out. And in order to do that, they have to use what? Price. Without price, the time advocate has nothing to advocate. Everything revolves around the price, ladies and gentlemen. I'm here to argue that it matters not when you buy a particular asset, but what is more important is the price. You can make an argument that had you bought Bitcoin, let's say 3 months ago, you would be in profit today. That, technically speaking, is a fact. Because had you brought it at any time in the near past, prior to it reaching today's price level, well, then yes, you would have made profit. But the argument isn't just purely about profit and how much profit one could have made. The real discussion, the real issue is how much profit. What is the most opportune, what would have been the most opportune moment, or should I say opportune price point to achieve one's goals? That is the real argument. That is what we're talking about today. What is price? We already know what time is, but what is price? Price, when it comes to financial instruments, when it comes to investing, is of the most key importance, because price can determine whether you win or lose, whether there be profit or a loss. We're always concerned with profit or loss, okay? So in a situation like we have now, we live today in a day that is different than times past. Now, I know there's no new thing under the sun, but under that umbrella, you can have multiple things that occur. They may never have occurred in that way, shape, or form before. So when you look at things, there's no new thing under heaven, but it's talking about as far as ideas in general and all the schemes that man has come up with. Okay, it's not talking about things. It's talking about mindset. It's talking about that. So from a price and asset class perspective, we're talking about the opportune price. Whether you know it or not, there is an opportune price to purchase something. All right? Case in point. Time advocate could say, well, see, had you bought Bitcoin 3 months ago and held it until today, you would be up today, even though Bitcoin is down 2,500 points. Right? Now, that is a fact. But the price guy will come and say, actually, that's wrong. Had you bought Bitcoin at this price right here on my chart, it says 15 cents, you would be ridiculously rich today. Who wins the argument? The price guy, because he's right. It doesn't matter when you bought something. When it comes to this argument with Bitcoin, it matters at what price you bought it. The guy who bought it at 15 cents is a lot wealthier today than the guy who bought it 3 months ago. Price and time are divorced. All right. Now, had you not brought it at that particular price, you can make an argument that you will never be able to do that again because it will never be 10 cents again. Okay. So price is important. There is an opportune price each and every day in each and every class and asset class. There's a opportune price in the euro dollar today. There's an opportune price in Bitcoin. There's an opportune price in Ford Motor or GameStop or Amazon or Facebook or Dogecoin or Theta. There is an opportune price to get involved in the market. At some point, there is an opportune price that will be reached that will signal that a market is ready to turn and head down. Likewise, there is an opportune price point in the middle of the day that, if reached, will trigger a bull market, a bull run, a rally. Every day, each and every market has a price point at which, if it is reached, the market will behave in a certain way. The majority of people know nothing about what I just said. They've never heard that before. I'm here to tell you the price matters more than anything else. Doesn't matter if you bought something 10 years ago and held it to today. What matters is the price. Price is king, ladies and gentlemen. Price tells you everything that you need to know about a particular asset class. That's all you need to know is the price. I don't care what news comes out. You and I, we are not omniscient. We don't know all things. We don't have perfect knowledge of the current present. We don't have perfect knowledge of the past. We don't have perfect knowledge of the future, and we don't have perfect knowledge of what if and or, woulda, shoulda, coulda. We're finite. But what we do have is what is called intraday price inflection points. Okay? So intraday price inflection points alert us that something is wrong. Prior to the market closing on September the 11th, 2001, the market did something to alert the average trader sitting at a trading terminal at that day. Even if they didn't have the news turned on, even if they were oblivious and trading from a cave, they would have been clued in that something is wrong. Something is just not right. Something is going on. Even though I am not privy to what is going on, something is the matter. I don't know what that is, but something is the matter. And that something would have indicated to the trader on that day that, oh my goodness, a particular support, an intraday support, has just been wiped out. Oh my goodness. We have circuit breakers on. We are now lock limit. The market has been timed out. Globex is taking a 5-minute trading halt because certain price points have been tripped. Therefore, it is now going to invite an overwhelming amount of selling. We saw that again just a few years later in the late summer of 2008. The last day of trading day of August, something happened. An intraday price inflection point was triggered. It was tripped. Even though we did not get a significant down push, because that intraday price trigger was tripped, it alerted a signal that in the coming days, selling has now been invited. Even though the selling pressure was absent on the day that the price point was tripped. What proceeded from that point, you already know the history. Total carnage. Why? If you did not know what was going on and you were just sitting in front of your computer screen, trading at that moment, you would have been clued that something is not right, something is very wrong. And you would have liquidated your long positions and may have even gotten short. And probably made out like a bandit. But then we saw just a couple of years later, we had a flash crash. And that was on May the 6th of 2010. How do we know that something was coming before it happened? Well, here's the information on that one that most people are not privy to. We were already in a downtrend channel 3 days prior, before the May the 6th situation happened. The bears were already in control of the market. You had no reason to be bullish. For 3 trading sessions in a row, the intraday price inflection points were tripped, even though you did not have significant downside. So that told you you needed to be on a particular side of the trade, and that was on the sell side of the trade. All right. So that morning, when that May 6, 2010 came, and when that flash crash hit and all those circuit breakers were tripped, it invited the whole world to sell along with it. And that's what happened. Price is king. Time does not matter. Price matters. If time really did matter when it comes to trading and investing, then options would never expire. They wouldn't need to. Because they'll say, if you just hold this put long enough, this will happen. If you just hold this call option long enough, the price will go up. We know that doesn't happen. Buy and wish is not a trading strategy. Buy and hold is not a trading strategy. And it is not a proper investment strategy either. You don't buy something and hope and wish that it makes money for you. It's not how you move. It's not how you move. There are certain assets that are illiquid. So by their very nature of them being illiquid, it's a buy and hold market. Buy and hold only works in buy and hold markets. Unfortunately, equities, even if they were at one point in time, they are no longer a buy and hold market. They're not. They're not. You can buy a stock today and the company can be out of business tomorrow. We have lost count on how many companies we've lost in the last 20 years, how many stocks have become delisted. Excuse me. There have been numerous ones. We're not even going to name all the ETFs that have been defunct. What would happen if you would have bought and held those ETFs? They're worthless today. Sometimes stocks go to zero. Sometimes cryptos go to zero. Forex and futures are designed to never go to zero. because we're talking commodities and currencies. If a currency went to zero, that means the country is now in full-blown collapse and it's failed. It's a failed state. So forex and futures are not supposed to ever go to zero, because a commodity is a commodity for a reason. It's because it is a limited natural resource. All right. So anything that is scarce, any resource that is scarce is a commodity, because it's scarce. All right. You can't print it like money. It's scarce. Physical gold, physical silver is scarce. There's only but so much of it in the ground. Okay. It's scarce. Scarcity is a whole nother issue. So things like baseball cards, real estate, jewelry, and other things, paintings, rare things like that, antiques, okay, artifacts. Those things are rare, and they are buy and hold by design, by nature, because their value is considered priceless. All right. So those things are designed to buy and hold because it's a priceless, scarce item. It's not a commodity, but it is considered a rare item, a scarce item. All right. So baseball cards, artifacts, antiques, things like that, those are buy and hold by their very nature of the markets that they are in the market for that particular item. So, of course, your great-great-granddaddy left you his baseball cards from 50 years ago, and now they're worth $100,000. Because, again, you buy something like that and you hold it because you never know what the value will be for it in the future. So, of course, and it is a liquid asset. It's not like I can just take a baseball card to the bank and say, give me some money. See what I'm saying? It's not like you can just move real estate that easy. You got to find a buyer first. What if no one wants to buy your property at the price you want to sell it? It's illiquid. It's not like our equity markets or our futures and forex and crypto markets, where for pretty much every buyer there's a seller, and vice versa. Those markets are not illiquid by nature. They're very liquid instruments by nature. That's why you can day trade them, because they're liquid. I can day trade theta. I can day trade cocoa. I can day trade coffee. I can day trade the E-mini S&P 500. I can day trade Facebook, Bank of America, Wells Fargo stock. Don't matter. I can day trade all those things because those are all liquid assets. For every buyer, there's a seller, and vice versa. Real estate is not like that. Automobiles are not like that. Okay? So we have to understand the asset class that we're dealing with, and therefore whatever nuances go along with that particular market. Each and every market has its own nuance with it. But something that cannot be shaken, something that cannot change, it doesn't ever change, is when we're talking about the tradable markets, we're talking about forex, futures, equities, and crypto. Those have intraday price inflection points that pass out signals to the bots that exist that this is going on, therefore this needs to happen. There is a price, whether you are privy to it or not, that if reached in the middle of a trading day will cause the robots to go in and make Bitcoin rally 10 grand in a day. Likewise, there is a intraday price inflection point that will make Bitcoin drop 10 grand today if certain things happen in that market today. Every market has an intraday price inflection point. Don't you ever forget it. Majority of the time, those intraday price inflection points are rarely ever hit. When intraday price inflection points are rarely being hit, we call that a sideways consolidated market. It's congested. Consolidation can take place topside the Kumo cloud, below the Kumo cloud, or inside of the Kumo cloud. You need to understand that and be aware of that as well. So When we have intraday price inflection points not being hit, that's a sideways moving market. Sideways moving market. When those intraday price inflection points are constantly being hit each and every day, we call that a trending market. Okay? It's trending. You got to know the difference. There are multiple intraday price inflection points. There is a key intraday price inflection point, but there are also multiple intraday price inflection points that are also there as well. You will not be able to find these intraday price inflection points on any chart. You will not be able to find them on a tick chart, a 1 minute chart, a 5 minute chart, a 10, 15, 30, 20, or 1 hour or 4 hour chart, weekly or monthly or daily chart. They do not exist there. These intraday price inflection points are a rare phenomenon that is relatively new, that has only been in existence, I want to say, since the 2010s. Let's say that. There have been multiple algo shifts in the market, and since 2010, algorithms now rule the market. They rule the day. All right, so because that happens, now you have these intraday price inflection points that signal to each other, to the robots, to each other, that, hey, Facebook is about to get dumped. Let's get on it before the market even falls. Up, price trip, warning, get in, and then you start seeing the robots pile on. Boom. Now you got a snowball effect. Okay. So price beats time hands down in just about every scenario you can possibly think of. It's all about the price. How do you get these price inflection points? You go to PulseWaveTrading.com and you can sign up to receive your daily PulseWave trading report. We have PulseWave reports on all the asset classes. We have it for futures. We have it for equities. We have it for cryptos. We have it for forex. You want to know what those price inflection points are? That's why you need PulseWave trading. These intraday price inflection points are extremely complex because what happens is during the course of each trading day, there is a specific price where money will start to flow in that particular direction. And once that price point is reached, all those orders are going to dump simultaneously. And that's what causes these markets to go crazy. All right. So now you know. Now you know what intraday price inflections are and where to find them. There you go. You won't be able to find them anywhere else. You won't be able to find them on eBay. You won't be able to find them on Amazon. You won't be able to find them at any of the trading exchanges. NASDAQ won't sell it to you. The New York Stock Exchange won't sell it to you. Chicago Mercantile Exchange, Chicago Board of Trade, none of them. All right. NADEX ain't going to give it to you. All right. None of them. QCoin ain't going to give it to you. Bybit ain't giving it to you. No one's giving it to you. All right. I'm the only one that got it. I'm the only one that can give it to you. PulseWaveTrading.com. Remember, smash that like button. That way more people can get the word out. Because you know how YouTube is. They marginalize you. They punish you. They don't let people see your videos. They don't alert people when you are going live or any of that stuff. And they even sometimes unsubscribe you and or subscribe you to accounts that you did not want to subscribe to and don't even know anything about. All types of sneaky tactics. With that being said, you know what it is. Bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. And I am out. Peace.